Don't just own crypto, also own some stocks, also own some bonds, maybe property, maybe gold. Don't put all your eggs into one basket, be diversified. I also subscribe to this actually. In this video, we are going to talk about stocks. We are going to talk about the potential stocks that might be able to outperform. We are going to talk about the things not to buy, and that is the vast majority. This is not financial advice, but I want to share some kind of thoughts that I have that most people don't. Now, here's what most people are not going to tell you. Most people aren't telling you that the S&P 500 is actually not making you money long term. What you've got over here is the S&P 500 divided by the US money supply. So the S&P 500 is only going up over time because money is expanding over time. This is a very long-term chart starting in 1959. It's going down, it's going up, it's going down, it's going up. There's no real net purchasing power increase over time. So we can't just buy the S&P 500. We have to be a bit more smart about this. Let's have a look. Check this out. This is the Nasdaq 100 divided by the S&P 500, and this tends to outperform very nicely over time. We had our dot-com bubble, right, the boom and the bust, but over the long term, tech stocks tend to do better than the rest of the economy. Makes sense because tech business models are scalable very cheaply across the globe. It's much easier to scale tech. You tend to have better margins as well. You tend to have monopoly effects as well, right? If you've got the best tech product, then you tend to accrue all the profit. And let's say we don't just want to buy the Nasdaq 100. Let's say we want to buy individual stocks as well. What we've got over here is Tesla divided by the Nasdaq 100. And it's interesting how the performance comes in those breakthrough patterns, right? It's almost like a step function. Now we are underperforming again by roughly 64% from the all-time high. This is again relative to the Nasdaq 100. We have seen something very similar in the past. From top to bottom, we went down by 62%. Now, is this a problem unique to Tesla? Is this a problem with electric vehicles as well? Let's compare Tesla with BYD, the main competitor from China. So this is BYD stock in US dollars over time, but we want to see relative performance. This is now Tesla divided by BYD in US dollars. So yes, Tesla isn't doing too well recently, but still over time it did way better than BYD. It more than 10x outperformed BYD. Is this an opportunity to buy? Potentially. At least BYD relative to Tesla tends to be rather on the higher end right now. If you're considering to buy an EV stock, Tesla is probably a better idea than BYD, at least just technically, right, looking at this relative valuation chart. Have a look at this. This is Nvidia relative to the Nasdaq. It's not just recently outperforming with this AI hype. We tended to see outperformance for almost 10 years now. And some of that GPU demand in the beginning of that rally was due to crypto mining. Here's Microsoft relative to the Nasdaq. Didn't have too great of a time under Steve Ballmer, but now is recovering. But still, it doesn't look like it makes too much sense to hold Microsoft idiosyncratically. As in, you can simply just buy QQQ, a Nasdaq 100 ETF, and you're still getting somewhat the same kind of performance with less risk. So why buy Microsoft? At least not according to this chart. There was a bit of outperformance, but recently this is also slowing down. Not necessarily sure if this is worth holding over QQQ. Here's Google relative to the Nasdaq 100. It's slightly outperforming, but very, very slowly. So maybe over the course of 20 years, an outperformance of 40% or so. So maybe also, especially given that we are again relatively high in the trading range, maybe also not worth holding. So this is how I think about this, right? If you don't have an asset that outperforms the benchmark, then why get into the asset? This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out. Getting into just one asset, so into the stock, is always more risk, right? You don't know what happens to the management. You don't know what happens to the business model. So getting the same kind of return by buying the overall index might make more sense. The risk with the overall index is lower compared to an individual stock, and the return is not necessarily that much higher for Google relative to the Nasdaq 100. It used to work really great, but in the last 20 years, it wasn't that much of an outperformer anymore. Here's Netflix relative to the Nasdaq 100, also not necessarily worth it. Here is Facebook Look that crashed massively when burning so much money with their VR headset. Then VR got somewhat slimmed down and the price of the stock 100% recovered. But maybe the upside is somewhat limited now as well. Here's Amazon relative to the Nasdaq 100. No outperformance in the last 7 years roughly. But the main profit driver is AWS still, right? So it's the cloud infrastructure that does get more and more competition by Microsoft and by Google. Here's Apple relative to QQQ. That's actually doing pretty well. In the last 15 years or so, we saw a 2x outperformance. The price doesn't seem to be astronomically high. It also doesn't seem to be low, but still a relatively constant outperformance. So I can completely understand to own Apple as an individual stock. So far we've got two stocks that seem to be outperforming the Nasdaq somewhat well. It's of course Nvidia, it's also Apple. If you wanted to take some kind of a gamble, then there's of course also Tesla stock. But Tesla is of course way more risky. Check this out. This is Berkshire Hathaway relative to the S&P 500. And this is how Warren Buffett got rich. He outperformed the S&P 500 very, very nicely. But that outperformance massively slowed down in the last 20 years or so, where the outperformance accumulated over those 20 years was only 30% roughly. Now this is relative to the S&P 500, and for all other stocks we looked at the performance relative to the Nasdaq 100, and we already looked at how the Nasdaq 100 tends to outperform the S&P 500. So let's have a look at Berkshire Hathaway relative to just QQQ, right? Relative to a Nasdaq 100 ETF. That's this chart over here. It's not that pretty. Had you bought Berkshire Hathaway instead of the Nasdaq 100 ETF 16 years ago, you would be down relatively by 67%. You'd have 3 times more money being in the Nasdaq 100 instead. So the stock market does work very similarly to the crypto market. Most assets tend to underperform the benchmark, and we have to be very, very selective what kind of individual assets to buy. You don't want to buy all kinds of random altcoins and then underperform Bitcoin. You don't want to buy all kinds of random stocks and then underperform the Nasdaq 100. As a baseline, it makes sense to have Bitcoin. As a baseline, it makes sense to have QQQ. And if you want to sprinkle in some other assets, that's fine, but don't go overboard and have a very strong conviction in those individual assets. Make sure when you get into an individual asset such as Tesla or Nvidia or Apple that you actually have a very close eye on what the company is doing and where the company is headed. Because again, the trend can change for an entire industry, as we're currently seeing for the EV market. Tesla is not doing poorly because Tesla is doing so badly. It's simply just the EV market. BYD is doing much, much worse. If it's your first time here, feel free to subscribe. I publish videos regularly, mainly on crypto. If you want to give this a like, that would be very much appreciated as well. It does help the channel grow. In case you do have Telegram, then feel free to join us. The link is down below. Looking very much forward to chatting with you.